What's going on, everyone? We're going to talk about covered calls and the road to passive income. Now, we do have lessons on this coming next week, starting Monday. For those of you that are interested in who have signed up, this is just a precursor to that to get your mind rolling and thinking about this. It's not too complicated. It's made overly complicated, like everything else in the market. Just think of covered calls as an ability to make passive income using the shares you've already purchased. There's no additional cost required to sell calls. You already have invested the costs up front when you bought the shares. So every 100 shares you have of any stock, for the most part, as long as they have options, you can write a contract for it. Now, before we begin, what are options? They're financial instruments which derive their value from the underlying asset, such as stocks. They give buyers the right, but not the obligation, to buy or sell an underlying asset at an agreed upon price and date. This is important to remember. It's saying that if you buy a call option at $75 and the price is at $30, and that stock reaches that price at $75, you don't have to buy it. You can if you want, you have the right to, but you don't have the obligation to. Same thing goes for puts. So a call option provides the right to purchase an asset at a determined price in a specified amount of time. A call that's long is bullish on the underlying, and a put option allows holders to sell an asset at a certain price within a specific period of time, and long puts are bearish on the underlying. So let's keep a simple example here. So imagine a stock's at 50 bucks. I can go ahead and buy it for $52. Let's say I want to buy a long call at the $52 strike, but the price is currently at $50. So I'm buying an out of the money call. I'm hoping, because I bought this in 2 weeks from now, that in 2 weeks, by 2 week time frame, this stock goes up to $52. Now, if it does, if it goes in the money by this time, that's what gives me the right to buy it, because it's in the money, it expired in the money. Now I have the right, but not the obligation, to exercise that call. And just so you know, the majority of options expire worthless, and the majority of options are not exercised. So that from the start gives the call seller a huge advantage. So factors affecting covered call strategy. The payoff is affected by the underlying, whether it's a single asset or a pool of assets. We won't have to worry about that in our strategy. We just focus on single assets for the most part. Premiums collected are dependent on the moneyness of the option. And moneyness, again, is at the money, out of the money, or in the money. So that's going to affect it. At the money is going to be, obviously, a little bit more expensive than out of the money. And then in the money is going to be more expensive than at the money, as far as when you're selling covered calls. So the further out of the money you go, the less risk you have and the less premium you have to make when selling. The further in the money you go, the more premium you get up front, but the more risk you have of your shares being called away. Now, option premiums tend to increase during volatile markets. This is where AMC and GME holders mess up every week, chasing hype on YouTube and Twitter, because whenever the price goes up for a couple days and everyone gets jacked and they start buying long calls, that's exactly when they're starting to sell calls to rake in that premium from inexperienced options players, not playing any premium and only playing the risk side of the market. They clean them up and mop the floor with them every single week. They're going to do it again this next coming week, so just keep that in mind. However, if you're aware of this and you're not scared to sell calls because Reddit told you not to play options, you have to realize that options, the definition of options, is to literally give you more than one thing to do in a situation. If you're stuck buying and holding and not utilizing sold calls, you're leaving money on the table, and despite how you feel, that is a fact. Now, when you write a call, you are using the shares you already purchased to generate yourself income while the stock isn't going up. Maybe it's consolidating, maybe it's going down. This gives you an opportunity and a vehicle to make money if the stock doesn't go the way you want for your original long position. And you don't have to pay a dime for it, unless it goes against you. But if you sell above max pain when just starting out, which is what I recommend, 9 times out of 10, you're going to be just fine, because especially in our plays, because max pain tends to govern where the stocks move, especially in our plays. Now, when you sell covered calls, you keep the shares. Again, let's say everything goes perfectly and the call expires worthless. You get to keep all the premium. Guess what? You also get to keep the shares, meaning you can reload, rinse, repeat, do that again. I like to sell calls weekly. It's weekly passive income. 30 go-to calls after a nice run. If you're patient, you can end up making $700 a week on passive income. and it's a great thing. Now, there is risk involved, but that's why you just need to be careful and go slow. And when first starting out, again, wait until runs to sell, and when choosing the strike price, sell above max pain. Now, and another thing, whenever you're imagining selling calls, I want you to imagine that you're selling it to yourself, because that's what you're doing. So whenever you buy a long call, what happens? The stock goes up, you make money. The stock goes down, you lose money. So I want you to think of it this way. Whenever you have a covered call, just imagine what the other person on the side of that covered call is doing, because technically that's you. Before you sold this call, you had only bought calls. So what would you be doing if you had this covered call open and the price started to go down? You would be losing money. But now, since you have the covered call, you're making money and you can buy it back anytime. So if, let's say I sold a call and the current price of the stock was $50. Let's say I sold the call for $10 of premium per contract. Well, what happens if that stock goes up, or that option contract goes up in value by $2? You would lose $2 because you're on the covered side. The buyer would gain $2 because they're on the buy side. The opposite is true if the price goes down. You start to make money, and then the call buyer on the other side starts to freak out, and you've been through those emotions before. Imagine being on the side without theta. Huge advantage. So there's a few steps involved when finding covered call opportunities. Number 1, choose a stock. That's already made easy for you. Anyways, most investors prefer to buy stock in companies that they're comfortable owning over the long term. That is, they should have strong fundamentals and predictable volatility. This is GameStop in a nutshell, yet none of them want to sell calls because reasons. The entire stock portfolio should also be diversified to minimize and maximize income. Choose the expiration. Most covered call investors use rolling monthly options because of their liquidity and rate of return per unit of time. While weeklies provide greater income potential, monthly options are a good balance between risk, return, and time commitments when it comes to setting up trades. I would recommend starting weekly when starting out. Go way out of the money. Just try to get a few bucks of premium just to see how it works. It's free money, just until you get the hang of the mechanics. Now, number 3, choose the strike price. Again, when first starting out, outside of max pain is the easiest way to go. When you get a little bit more experience, then you can go in the money when you're expecting a drop. That way you get more premium. But for now, just until you grasp the idea, it's very safe just to go far out of the money. Maybe $2, $3, $4, $5 a contract, just to get some experience in what it's like holding them. Because again, whenever you buy these calls, you can technically, like if you bought these calls and walked away and forgot about it for 2 weeks and then came back 2 weeks later and the call expired worthless, nothing would change. You just have the extra premium in your account still. Now, managing your positions. Writing covered calls is an active trading strategy that requires regular follow-up. And again, you don't want to be open with a covered call strat and then the stock go titties up and then all of a sudden you're in a pickle, especially if you want those shares. In addition to setting up new positions every month, in this case we're going to say every week until we get the hang of it, you may be faced with important decisions mid-month or mid-week, such as whether to buy back or deliver the stock if an option is called by the option buyer. Now remember, the only way that the option can be called by the option buyer is if it's in the money. And if it's already close to in the money, you should probably already consider buying it back anyway. Now, in order to make the optimal decision, it's important to understand all of your options available to you as well as the pros and cons of each option. That's why they're called options. Reddit narrative doesn't want you to know your options. They want you to buy and hold because it takes your options away from you. Suppose that you have a covered call position that's at risk of being called away because the stock price is rapidly moving towards the strike price, or there is an upcoming dividend, which also affects calls. You got to pay attention to those too. In this case, you have several ways that you could react, and each has its own pros and cons to carefully consider. The 3 primary choices that you have include: you could take no action and let the stock be called away. The benefit of the strategy is that you receive cash from the stock sale and don't incur any other costs, but the downside is that you may be taxed on the capital gains income. So again, you don't lose everything. Misconception. You could close out or unwind the position by buying back the covered call and either keeping or selling the stock. The benefit of this strategy is that you don't necessarily have to sell the stock, but the downside is that you will lose money on the options trade. Take your loss and move on, try again. 3, you could roll out the position by buying back the covered call and selling a new call at a later date, higher strike price, or both. The benefit of this approach is that you don't have to sell the stock and that you can minimize your losses on the option trade, but the downside is that you're committed to a new option position right away. So those are your options. That's why they call them options. Now, what options should you choose? 2 key factors. Expiration month. An option's value decays faster in the final 30 days of its life, which means that most investors stick to monthly call options rather than longer-term options when writing covered calls. As unlike when you buy a call, theta, or time decay, is actually on your team now. That's tit-jacking worthy. 2, strike price. The easiest way to select a strike price is to verify max pain and then sell your call slightly above max pain. The less comfortable you are, go a little higher. The more comfortable you are, go a little lower. Remember, you can buy them back anytime. Your hands are not tied whatsoever, and you do have several options while holding options. 3, timing. I put 2. 3 key factors. Number 3, timing. The ideal time to sell calls is after a run. Like, for example, GameStop goes up to 120, where it was 2 weeks ago. And then, for some reason, that incentivizes social media to justify a hype narrative that gets everyone thinking about buying calls and not selling calls because Reddit says not to. And then what happens? The hedge funds get a nice sum of premium put right in their pocket by unwilling and just, it's the same mistake on a weekly basis. At some point, you got to learn. Make the free money. It's sitting there for you. The bottom line, the options market is 2 things, risk and premium. If you're always on the risk side and not utilizing premium, you're making things extremely difficult for longevity. Covered calls are a great way to generate an income for a portfolio of stocks. Rather than haphazardly selecting options based purely on return, you should build a comprehensive strategy that factors in both risk and return. You can then ensure consistent income over time. That is the only way. You might get lucky on the risk side, but at some point in time, if you're going to be in the market for an extended period of time, you've got to utilize premium. We will begin lessons Monday for those who have signed up. I look forward to it. It's not going to be that complicated. It'll take probably a month. So as soon as we're wrapped up, just remember to downgrade, go back to normal membership. We're all good. This should help the group especially understand different options. We need to get people on board learning what their options are. The options market is called the options market for a reason, because it gives you options. I don't care what Reddit says. They've been wrong about 8 million things last year. It's time we stop listening to a bunch of idiots that don't know what they're talking about. I'm not talking about Reddit in general. Mainly Superstock. Plebs. But anyways, if you want to learn and you would like to expand your knowledge and utilize the other half of the options market, I'm opening this to the public. Members and non-members can join. There's a group on Patreon for it and YouTube if you'd like to sign up. Totally up to you. If not, so be it. This is only for those that are interested, and I'll do everything I can to make sure that I explain it in a way that you can understand. And we'll use real-time examples as well. So that's covered calls. Things to remember: you do not have to sell your shares unless they expire in the money. Even then, you don't have to sell them unless they're called. Most options are not called, so keep this in mind. If the price starts to approach in the money, you can close out your position by buying it back any time. When you sell a covered call, you get buying power in your account immediately upon selling it. It is important to know that when you are a new investor, do not spend this money just in case the trade goes against you, so you have the available capital to buy it back. And again, sell above max pain only after runs in periods of high volatility. You want to buy options when they're low volatility. You want to sell options when they're high volatility. It's very, very simple, and I look forward to getting this rolled out next week or tomorrow. Have a good one.